Today I'm going to talk about what's going on with Luckin Coffee. What I did on Friday was I actually exercised 100 put options at a strike of 350. It is a very risky proposition because 100 put options, 10,000 shares. The stock were to open at some point down the road, I would have to buy whatever the stock opens at and agree to sell at 350. So potentially the best case scenario is the stock gets delisted and I basically buy them at zero and sell at 350. I did spend 8,900 on those options. I purchased them on April 6th, and on the 7th, the stock was halted. Nothing was going to be able to trade. Basically, I had two options. One is to let my options expire worthless or exercise them and face potential loss. I had about a month to do some research in order to derive to my decision. I looked into a lot of different message boards. I watched a lot of videos on Luckin Coffee. I read the 89-page report published by Muddy Waters. I studied their business model. I read their financials, read every single piece of news article about them, both in Chinese and in English. Conclusion that I derived at, which is there is a high likelihood of them not being listed again. I'm using this video to record my rationale. For everyone that's watching, you can basically see how I came to my conclusion. And you may disagree, especially if you're holding stocks at this point. I welcome any counter argument that you may have. I think this is a very interesting case, generated a lot of attention. Everybody knows at this point that they self-admitted on April 2nd that they had committed fraud to the amount of somewhere around $310 million over the past 3 quarters. Basically, that was the last time they were audited right before they went public. Ever since they went public, they started fudging their numbers. According to the report published by Muddy Waters, the fraud started back in August of 2019. And I'm not going to go into the details of that report, but a lot of the materials that were presented, they were very detailed, very well presented, and they just seem to be, factual information, very hard to argue against. The next point, I think their business model is broken. They try to expand very quickly, grow their customer base, and obviously that's just something that didn't work out for them because the customers base that they attract is very price sensitive and they don't necessarily need a coffee. They were just basically bargain seekers. And as soon as the discounts disappear, they stop coming. So there is not a very loyal customer base. Luckin Coffee, they opened their first store in January of 2018. They had some internal funding by the CEO. Planning phase started all the way back in 2016. They were planning on this coffee concept. After they opened their first store in 2018, they were able to secure their round A funding from Joy Capital, Legend Capital, the GIC, and then Centurium Capital. When you look at, kind of behind the curtain, everybody that's involved in these 4 firms are part of the chairman Lu Zhengyao's circle. They were all somehow connected previously. It is a very closed circle funding. In June of 2018, the CEO, Qian Zhengya, she was able to get the funding. And then in December, she received a second round of funding for the same amount of money, $200 million. By June of 2018, they have about 800 stores, 800 to 1,000, because by the end of 2018, that's when they kind of reached their second milestone, when they get their round B funding of $200 million by pretty much the same investors. But by that time, they already have 2,000 stores. They set a goal to open 2,500 more stores by the end of 2019. So this was all very well planned since the beginning. They knew what they were going to do. They knew what their strategy was, and basically they need to grow very quickly in order to attract the attention of larger firms, more reputable firms, because their ultimate goal was to IPO in the United States. They were able to get their round C funding from a very, very reputable firm, BlackRock, in April of 2019. The amount was actually less than the previous 2 rounds, but it doesn't really matter. It's all about gaining the confidence from someone who understands the coffee industry, because BlackRock also invests in Starbucks. and some reputable firm from the US, and that would basically just open up the door for them to be introduced to the US and eventually attract more investors and investment banks and allow them to IPO a month later. So in May of 2019, they IPO'd on the NASDAQ, received $651 million. They were expecting to sell between 15 to 17, and then they sold on the higher end. They sold at 17. They grew very quickly from the first store to basically going IPO with a matter of 18 months. So just 8 months later, they did a secondary offering, another $418 million, sold at $42 a share. So this is the recent timeline for the ascension of Luckin Coffee, basically becoming the unicorn of the coffee industry, achieving something that no one's ever done before. However, now you're looking at how closely those financial events are happening right next to one another. You start to wonder, why they're burning through cash so fast. Well, by looking at their financials, it seems like it's just because they're growing, they're opening a lot of units, but it doesn't explain the reason why they have to commit fraud. Well, some might believe it's out of greed. Upon a closer look at their numbers, I believe it's out of necessity. So in order to figure out the reason behind their scandal, we should be taking a closer look at their actual sales and the sales numbers that they presented. And that way, we'll figure out exactly how fast they're burning through cash, and that will provide the reason for their secondary offering and kind of explains why they almost had to commit this fraud in order to survive. So the Muddy Water report said they inflated their sales and their expenses. So I actually did some math. I looked into their SEC filings, and also I made some assumptions on my own. And this is how I derived their sales numbers. So if you look at their store number in 2018, they ended the year with 2,000 stores. So that means for the entire year, they averaged about 1,000 stores. And we know that by the end of 2019, they have 4,500 stores. So I'm assuming they average about 3,250 for the year. So we know this number is somewhat reliable. And so what I did was I just used their 2018 number and multiplied by 3.25 to get their sales estimate for 2019. And I think this number can be generous because we are basically assuming that by opening more stores, they're not cannibalizing any of their existing stores, which is usually not the case because what happens is when you open more stores, your sales per store usually goes down, especially when you expand in such a short period of time. So I took their actual, and their cost of goods sold was actually higher because, as mentioned in the report, they actually inflated their sales price. By making that adjustment, we know cost of goods sold is actually 7% higher than what they reported. That gives you a gross margin for the whole year, $163 million. Their rent will be the same. I actually reduced their marketing expenses because in the report it says they probably inflated their marketing expenses in order to funnel that back into their sales figures. So what I did was I looked at pre-IPO marketing expense and I just extrapolated to a whole year. This is the marketing expense that I calculated, and this is the one based on what was in their financials. SG&A stays the same. There are other expenses which includes depreciation and expenses related to opening new stores. So all the other expenses stay the same. And look at the net income. This will give us a cash flow of negative $482 million. So altogether, they inflated their sales numbers by $310 million, and they also underreported their expenses by about $100 million. Okay, so now with this information, let's go to the next slide. What's going on with their operation? Why are they cooking the books and try to inflate their sales? Well, because if they don't receive the money in January by pumping their books, if they don't create a fast growth story which will allow them to receive additional money in January, their cash flow will become a problem. So let's look at this cash flow chart. So based on the end of 2018, their balance sheet says they had $228 million of cash. They received this much for their IPO. This is how much they spent for the first 9 months of the year for 2019. Based on my calculation, this is what they reported. About the same. This is all the information that we know right now. So after that, what I did was I estimated that their cash outflow for the fourth quarter to be around $130 million. This is the difference from cooking their books. So we need to subtract this out from their cash holdings. Once you add everything together, and I am assuming that for the first quarter of this year, their cash outflow is going to be around $150 million. This is a pure estimation. It's just based on now they have more stores. Well, sales has been pretty abysmal because of COVID-19 that's currently going on. I would assume that their sales number is only a fraction of what it was. Based on these numbers, this is the estimated balance in their cash account today, or by the end of March 31st. They have $1 billion, right? It looks like it's a lot of money. But let's imagine, what if they didn't receive their secondary offer back in January? So this would be the cash on hand that they would have today. Based on the rate of their cash burn, if they were not able to receive any of the funding, then their cash on hand would only last them for a little over 1 quarter. So that means they will run out of cash by July. But because of the secondary offer, now they have 8 quarters of cash burn, basically. But in order to achieve this amount, again, what they did was the secondary offering, they received a total of $865 million. So their stock offering were sold at $42, and then they also offered the rest in a convertible bond, which is highly correlated to their stock price. The market usually perceives issuing convertible bonds as a form of stock, hoping that at one point the stock price will go over the conversion rate, the conversion price. Basically, the investors can have upside because the convertible bonds were actually issued with very low interest rate. It was 0.75% coupon for the whole year. Now, let's look at their stock chart. This is their stock performance since their IPO. For the first 5 months, the stock had stayed very consistent. There wasn't a lot of up and down going on right here. As soon as we go into November, after the third quarter numbers came out, and you start to see this tick up. And this is what they planned for. It went all the way up in the mid 40s by January. And this is when they did their secondary offering. Let's just assume if they never pumped their books. The best case scenario is that they did a secondary offering at $20 and maybe they were able to gain some traction at this amount. But I doubt it, because that would raise a lot of red flags. Investors will be looking at the company and question, you're not growing, why do you need additional cash? They basically have to put on this window dressing and pretend that they are a fast growing company that's burning through a lot of cash, which makes the story reasonable. So let's just assume that they were able to receive some kind of secondary funding at 20. What they end up receiving is actually a lot less than what they have right now. So instead of having $1 billion in their cash account, they would probably just end up having somewhere around this number, $340 million. In reality, if their stock stayed at 20, they might not even be able to issue any secondary offering. But even at this number, it's only going to last them for about 6 months. So now we know fundamentally why they did it, because they needed money. So let's look at this. Their cost and pricing. According to their financials for 2018, they sold 90 million cups of coffee for the whole year. The average price that they were able to charge was $1.30 per cup. And for the whole year, they lost $226 million. So that means the cost of each cup of coffee was $3.80. They were only able to sell it for $1.30. So for every 1 cup that they sell, they lost 2 cups. And that is an amazing rate of cash burn. For 2019, they still sold their coffee around the same price. So at a store level, we know it's very hard for them to make profit. And 2 is their user base. There were a lot of downloads for their app, but according to this big data firm, they tracked how active the users are for Luckin Coffee, and there was only 1% of the downloads that were active users. Their downloads is about 4 times as many as Starbucks, but their active user is only 1/10 of Starbucks. We know that their actual sales number is going to be much, much lower than what they reported on their financials. And it's very possible what they did was they actually funneled the money into this company called Focus Media, and then the money comes back into their account, kind of further inflate their sales. Basically, they're treating their income statement like the balance sheet. They're kind of balancing it out, right? The income is the asset and the expenses is a liability. So they're kind of, inflating both to create a growth story, a bubble, but at the same time, it's very hard to trace, or at least they believe it's very hard to trace, because at this stage, people aren't really expecting them to start making a profit as long as they're trending into the right directions. So the next one, I think they have a huge issue is their management, because their COO, now he's no longer with the firm. Soon after that, a independent director left the firm, and their CTO, who's only been with the company for about 8 months. And this CTO, he has a great track record. And also, why is he so important to this company? Well, if you really think about Luckin Coffee, what makes them different? Because they market themselves under a technology company. So the CTO leaving is actually a big deal. So we spent a lot of time talking about cash. The moment they stop getting additional funding, or the moment the next person or the next sucker stops coming in, they will dry up. Given what's going on with the current scandal, it's almost impossible for the company to receive additional cash, especially, and now their business model hasn't really been proven. A lot of instabilities within the firm. I actually went on social media looking at how just regular people reacting to them, how their employees are reacting. There were a lot of negative sentiments regarding the company. It's not like Chinese people don't care about right or wrong. The firm is not doing something right. When it becomes a national embarrassment, people tend to steer away from it. So we talked about how their business model doesn't work. They don't have a loyal customer base. They are in desperate need of cash in order to continue their story. And now that lifeline has just been cut off for them. They had to cook the numbers. They have reached the breaking point where they will no longer be able to survive without doing it. We all know how the entire services industry have been impacted by COVID-19. I believe their sales have been hit just like everybody else. And because they have so many store locations that were about to open, right? Either open or about to open. Either way, they already have expenses incurred, right? Either they already signed the lease paying rent, or it's under renovation, but right now they can't open. So they have basically a lot of dead money that they put down and continue to spend without being able to open. Given how much other businesses have been impacted, I believe their sales for first quarter of this year is only a small fraction of what it was last year. The next point is the default. Chairman and the CEO, they borrowed $500 million. They pledged their equity against the loan as the collateral for their loan. And when the share prices pummeled and somehow they defaulted on their loan, and the banks headed by Goldman Sachs has to recall all of their shares. And when you convert their shares to the ADR, about 76 million shares. The chairman of this company, Lu Zhengyao, he's the CEO of another company in China that's being public traded. He personally has a lot of connections within financial industry, and he's the person behind orchestrating the entire deal from seed funding to eventually going public. So he is very experienced. If he's not able to find somebody else to fund him, that's possibly because his other company is also in trouble. They also need cash. Otherwise, he will find a way to somehow funnel money from the other company into this one and save his shares. Because if you look at it, at $40 a share, all the stocks that they pledged is worth about $3 billion versus the loan itself at only $500 million. If they still believe that their company is worth something around this number, they would somehow find a way to not default on their loan. The fact that they did, because they really didn't have any other options. They just ran out other resources, their arsenal, and they cannot come up with the money to make the payment. On the other hand, they don't have the shares anymore. What is there left for them to care for? Because they're no longer, at least the CEO, she will not have any ownership of the company anymore. So what is she really doing now that she already basically cashed out? And the other one is, I think it's something that's been kind of brewing in the background for a long time is because of this actual short sale report that was handed to Muddy Waters, right? It was done by somebody else. And if you actually read the report, you look at it, how detailed it was, the amount of work that went into it, and also the amount of information this person has, it just looks like somebody that's from the inside. This person knows about the company, knows the in and out. This person knows exactly where to look. This person knows the industry, the founders from a long time ago. He knows their history. This report definitely looks very personal. There's definitely some animosity that's been going on for a long time. So it's not a coincidence. Another indicator that I looked at behind the scenes is the convertible bond that's being traded. Even though the stock is halted, but the convertible bond for some reason is still being traded. And when the stock was halted, the bond value actually just tumbled alongside the price of the stock. It dropped to as low as 10 cents on the dollar. The convertible bond actually has a conversion price at $54, somewhere around there. So basically, at the current price of the stock, there is no real possibility of the conversion happening. So the bond actually matures less than 5 years, and matures in January of 2025. So in less than 5 years, the company would have to pay back at par. Even in a scenario of the company actually going bankrupt or restructure, they would still have first claim because it's a senior unsecured debt. And at this point, the company is not carrying any long-term debt. So basically, whoever owns this bond has claim over their assets, over their cash. We know that they have about $1 billion in their cash account. Whoever owns this bond will be able to receive par in 2025, so less than 5 years. And what that means, and at the same time, obviously, they're receiving a coupon payment every 6 months. And that gives the owner a 78% annualized return, compound annualized return. So a lot of bulls, what they do is they actually look at this as a signal. They know that usually the change in the convertible bond is an indication of the change of the underlying equity price. So they're looking at, okay, so it was trading at 10 cents per dollar, and then a few weeks later, it started trading again, and then the price went all the way up to 32.5 to the dollar. And they see it as, okay, so this tripled in price. That means, whatever the stock closed at, which is 439, that's going to triple. Well, convertible bond is only correlated to the stock price. It's very similar to options, right? It's correlated to the stock price to a certain extent, like when you are very close to the conversion price. The further away the actual price of the stock is from the conversion price, the less of a correlation there is between these two. However, what this does tell me is even at this price, you're still getting a 29% annualized compound return, and you still have first claim because you're a senior unsecured. If the company were to go bankrupt, it's very possible that I can double my investment within a year. By pricing it at 29% return, the market is still pricing in a very high default risk, because we know a lot of the high yield funds are only returning between 8 to 9%. So having something that's returning close to 30% means it's much more likely to default on this loan. And at the end is the sentiment surrounding Luckin Coffee in China, both within the business community as well as the consumers, because I've actually read something online that people went into Luckin Coffee store and the store is unexpectedly empty a lot of the times. They spend a good amount of time there on different days in different stores, and they're seeing a very consistent phenomenon. After they announced kind of financial scandal, there was a huge rush of people going into the stores because they were scared that the money they put into their app will no longer be able to use. They were selling a lot of prepaid cards. If you buy 100, you only pay 70 for 100, something like that. So a lot of people were already depositing the money into Luckin Coffee's account, and then basically they were just waiting to use it over time. For a lot of those customers, either one, they were using very low discount coupons, or they're using money that was already paid into Luckin Coffee. So they were drinking those coffee, while Luckin, on the other hand, will have to spend more money for purchase more supplies while there's no cash coming in. And the next factor that I looked at was political environment that's surrounding this entire case, what's going on between China and the United States. The Chinese Security Exchange Committee has really cracked down on Luckin Coffee and on this kind of behavior because right now what's at risk is all the Chinese companies that are being listed in the US. All their reputation are being questioned, and it's very possible if this case isn't dealt properly, access to capital will just completely cease for Chinese companies here in the US. So the Chinese Security Exchange Committee has basically taken over the investigation in Luckin Coffee. They've raided their office. They went in there. They basically took control of their cash account, and they're actively cooperating with the SEC in the hope to actually regain some of the American investor confidence. But really read this as Luckin Coffee cooperating with the security exchange. I think Luckin Coffee is already a foregone conclusion. It's right now at this point is really about interest of all the other companies that are here, which are hundreds of them, at least over 200 of them, all much larger and much more well known as far as their business presence. And I think on the other side, the SEC, holds a very similar viewpoint, even though it's for a different motivation. Because the SEC now wants to make Luckin Coffee an example to make sure that everybody else that's listed here is also playing by the rules. If they allow Luckin Coffee to, after such obvious scandal, because that 89-page report is out there in the public and everybody can read about it, and if they don't do a very thorough investigation, punish all the parties that are related, then they are setting an example for the next person to follow suit, because the cost of committing a crime is too low. That is basically encouraging other people to do the same. There's a lot of friction between China and the United States, the trade war that's happening between the country. The American people at this point have a very negative sentiment towards the Chinese government, towards any kind of Chinese business entity. By doing so, basically, the SEC is in line with the American people's wish. And the other one that I look at is obviously past cases. And a lot of times when you decide what to do in a certain situation, you always look at how similar cases in the past have been handled. So when we look at 20 years ago, what happened to Enron, even though you might believe it's a different scale, actually what Enron did was they falsified their sales numbers by $1 billion. At the time, Enron's market cap was about $70 billion. Luckin Coffee at its peak, when it was trading at $50 a share, its market cap was about Enron at $70 billion. They fudged their number by $1 billion. That's 1.5% of their market cap. And we all know what happened to Enron. Enron at their peak, they were trading around $90 a share. After the scandal, their price dropped to 26 cents. They declared for bankruptcy and restructuring, and eventually, started paying back. A lot of their senior executives went into jail, and they basically continued to pay their fines 10 years after this happened. So well into, I think, 2011. So a very similar scenario could happen to Luckin Coffee's executives if they found involved. And given what's going on, it's very hard for the CFO and the CEO to actually get off the hook. And I believe, and if the marketing numbers were actually pumped, I think the CMO, is very hard for him not to know about it. And usually it's a lot of times, everybody at the top are involved because, the only person who doesn't kind of hold any financial interest in the company was the COO. I mean, he was just an employee. He has no ownership. And what's his incentive for doing something of this magnitude? The last one is the actual fallout. Like I said earlier, we already know that they received their secondary funding with fake financials. So at least they had to pay back the $865 million. There were also a lot of litigations against the senior management. And even though they might not go to trial, but they're very likely to be settled outside of court, because if you look at how much cash that's in their account, around $1 billion. They probably spent more by this point. It's probably well under that. Now they have no access to additional capital. Out of that, they would probably have to pay $865 million to the investors back in January. The rest of it, they would have to pay for the litigations, the class action lawsuits. And at the same time, the SEC is going to slap them with a very, very heavy fine. I just don't think they have enough cash to actually continue to operate their business and at the same time meet up with all the all these payments. At the end, I want to just kind of go over a summary of everything that I talked about and what I believe are the three likely scenarios that would happen. The first one, they will get delisted and go to OTC counter, or they will be taken private. I think there's about 10 to 20% chance of that happening because I don't think it's very likely for anybody to actually purchase a company because one, the company's reputation is very tarnished, and two, what are they really purchasing with the company? What does Luckin Coffee actually have? They don't have their CTO anymore. They don't have any senior management, so you are not really paying talent. So what are you buying? Are you buying assets? Well, they have no assets that's really worth anything because they don't really own anything. A lot of their machines are probably leased. They don't own any of the properties. They don't own any land. Really, what are you buying? Are you buying the brand? Are you buying the product? I mean, they don't have there is no product differentiation. Their product is not unique. They're just selling something cheap and is not a proven business model. So for anyone, I don't know what they would be paying. If you were to buy the company, basically you are faced with a lot of litigations, a lot of risk. How do you assume the potential risk when you figure out the price? Could be negative. Delist and go bankrupt. I believe this is the most likely scenario because I think for everyone that's involved, there is a incentive to actually delist. If you look at from the Chinese government side, if they delist this company, that means they're really taking it seriously, and that may change the image of other companies that are being traded on the U.S. exchange. For the SEC, held their standard, and they've done what the American people want, which is protect their pension plan, protect their 401k, and protect their interest. The company itself, like I said earlier, a lot of the senior executives in the company, they no longer hold ownership interest in this company. So why would they want to be listed in the US again when they can kind of restructure and just go under the radar and maybe salvage some of the business that's still viable and figure out a way to pay all the litigations and maybe the business can eventually survive. And the most unlikely scenario that I believe will happen is the stock continue to trade. I think one is very unlikely for the SEC to allow someone, especially given it's such a high profile case, a lot of people are looking at it, to continue to trade. What kind of signal is it really sending by allowing that to happen? And two, I really don't think the company wants to continue to trade on the exchange. I mean, what's the point of them doing it? By trading on the exchange, that means you are going to be constantly scrutinized by the regulators, by the investors here, and you are not going to be able to offer another round of offering anytime soon at any price that you feel like is reasonable. You know that the business is not really a viable model, so it's impossible for you to get funding. It's impossible for you to make a profit, at least in the short term. What's the reason for staying on the exchange and face all these tight regulations and tight supervision while paying a very high fee to pay for the auditors? You have to comply with all the different regulations, and being listed, you have to pay a fee. So what's the point of doing that when you know that you've already lost all confidence from the investors here and you will not be able to access additional capital here? So I don't think the people in the company are incentivized to do it. Given everything that I've talked about here, I know it's a very long, I'm not very used to doing things like this, but hopefully I have explained my rationale. I hope if you're an owner of the stock, you currently carry some shares and you believe I'm wrong, I welcome you to comment below and we can start a discussion. I feel like this is going to be a very healthy debate. Given everything that I've looked at, this is the conclusion that I came out to. And basically, I already put my money where my mouth is by exercising all those shares, and we'll see what happens.